about to turn $2,300 into $6,000 in 65 weeks using a strategy that most traders have never even heard of. You're going to watch me place the actual trade today. This is called a poor man's covered call, and I'm using TQQ as my underline. No theory, no fluff, just pure execution. You're ready to see exactly how this works, aren't you? Let's do this. I'm going to be looking at trading TQQQ, but I'm going to go out to, I hope you can see that because I can't blow it up any more than what it is I'm going to go out though to right here at $110. I'm carrying a 50% or 60, almost a 60% delta. So I can buy that, a contract of that right now or at my target price, and I'll probably pay about $24 for it. So 24 times 100, which that will cover 100 shares, will put me, basically I'll be invested at approximately $2,400. And then as I, work through that, because you can see my brokerage account here, right, guys?
Yeah, we can.
Okay, thank you. And so that's the initial idea. I want to get into a position, not necessarily because it has a chance to go up, because it's going to be like buying my rental house, and then I'm going to generate premium against the rental house. And so what does that look like? So I'm going to show you completely before I enter, and also I'm going to show you setting up the trade to get in, and the math behind the 2,400 turning into 6,000 bucks. You watch me do this trade live, or at least set it up live, and I will place the trade. Step one is basically, as I said, I'm in week 3 of next week. So week 3 of the challenge, and I want to buy the TQQ leap if price actions drop to between $96 and $101. So right now, it's sitting, of course, at TQQ is sitting at what, 98. So I'm in the position where I could go ahead and do this trade, and we will. My strategy, a poor man's covered call, or it's also called the PMCC, is projected to gain 200% return as my target. And I'll watch, and I'll be watching it. You're going to watch as I set up the conditional order, and actually we'll place the trade. We'll place the trade today. So let's go. And so what the heck does this work out? I target, and we'll talk about this a little bit, shortly, is about how do I choose the call to sell against it. And what this shows is I'm looking at making about 75 cents, which would 75% over 65 weeks would pay for my leap position plus give me profit of about 2 times. So I would be generating 200%. This just gives you some idea of approximately the time frame that I would be doing this. The first quarter, I would generate about $975. Second quarter, I would have gotten up to $1,950. The third quarter, $2,925, and at the end of the first year, $3,900. And you can see I've already, at about the third quarter, I've already paid for my long, and I'll just call it the long leap. But here's what most traders miss. I'll show you the exact entry discipline that'll save you $300 to $400 when you place the order. You're ready for that, right? So let me show you exactly what we're going to do. Is basically I'm targeting the January 2027, which is 65 weeks from now, 110 call, 15 months out. Current price is about $24 per share. And my delta is, I'm looking for a delta of somewhere between 50 to 60. And so what that means is if it has a delta of 55 cents, 55 for every dollar that TQQ moves, it goes up 55 cents. My entry discipline is wait for a pullback because it will save me $300 or $400 when I buy the thing. And so I can set alerts at 101, 98, 96, but we're in that range right now. We're in that range right now. So let's jump over and set up the trade. Now, you may be asking, well, Dennis, aren't you going to wait for the rebound and all that kind of stuff? And the answer to that shouldn't matter that much. In other words, I am getting my pullback. Now, it may fall further, but and that's okay. But let's take a look at the okay. So what I'm looking at doing is I'm looking at buying one contract. I'm only going to buy one contract, and so I'm going to invest somewhere between 24 to 2,400 to $2,300 for this particular trade. Now, as you can see on the chart of TGGG, it is still going down. So I am going to actually set this up to go buy it at where it's down. I'm going to give it down to about 97.50. It may reach that today. And so 97.50. And to find out what that will be worth at 97.50, I go back to my option, or not, yeah, go back to my option table, which is here. And I go up here to my little bar. And so if it drops, okay, as you can see, if it drops 50 more cents, let's say, then if it drops 50 more cents, that's telling me that my price would be about $23.17, $23.10. And that's what I'll be willing to buy that's what I'll be able to buy this leap for. Again, I'm going to hold this leap for 65 weeks. My delta on that is 59. And so I can basically go halfway in between those prices right there if I wanted to buy it right now, which that's what my Theo price is. But let's just double check that. Am I still falling? I am still falling. So with that in place, let's go ahead and place the order. So I'm going to basically take that away. And I'm going to basically click here on the right at the 2370. I'm going to buy. And I'll buy a single. Now, what I'm doing right now is I'm building the foundation. In other words, the position that I will sell the leaps against. Now, how many do I want? I only want one. So I'm going to change this to one. But then what about my price that I'm willing to pay for that? I know the prices are still coming down, but I go back here and I just take a real quick look. And I'm going to go ahead and reset that. Go down to that 110. And I'm sitting so 2280 is the midpoint. So I'm going to go ahead and try to hit the midpoint on that. I'm going to go $22.90. I'm going halfway in between the two, the bid and the ask. Hey, watch what happened when I press submit. Then I'll show you the premium engine that will turn this into $6,000 in 65 weeks. So I'm going to launch that right now. And I'm going to make it actually good till canceled. And what I'm doing is I'm target shooting at today's current price level. Let's see if we get filled. And we did. So now I have bought this leap. And what did I buy the leap at? Let's go take a real hard look here. I bought it at $22.90 on the nose. And as you look here at my prices, you see this one on TQQQ from earlier today where I bought it. I was buying back a call that I did earlier in the week, and I sold it. I sold that one like at $3 and some change, and I bought it back for a nickel right there, as you can see. And the other one is, what's this? Oh, and also that's triggering me in to the TQQ trade we were doing earlier today. Next step is checking out the premium. What's the premium engine? Again, I'm looking at strike prices somewhere between a 50 and a 30 delta, and which is going to be approximately at or $6 to $9 above the current TQQ price. And the weekly income I'm looking to generate is somewhere between, actually my weekly income now could be actually less than, because if I bought it at what about at 21 makes it 70 cents is what I have to generate on this trade on every one of the calls that I sell every week. If I can generate 70 cents, then that will pay for that position plus it'll pay for the position plus add another 100% on top of that. And so I will have collected in total is just rounded up $2,300 in both premium and $2,300 to cover the cost basis for my existing order times 2, because 2290 divided by 65 is the amount that I would need to bring in on a weekly basis to just pay for the leap. And that's equal to approximately 70 cents. So that's my objective for this particular trade. If the price of this option, the leap option, cost me $2,290. If I divide that by 65 weeks, that tells you how much you need to bring in every week to just pay off that amount. I multiply by 2 because I want to not only pay off this, this sunk cost here, but I want to make that sunk cost. In the next slide, it will hopefully start to make some sense. So that's just the simple math. And it just continues to, as I said here, when you hit week 33, you should be just about break even. Now, I am presenting like you're going to win every week. Well, sometimes you don't. And in a later session, I will cover, well, what do I do when that is the case? And we'll take a look at that right now. So let's take a look real quickly back to the option table. And I go out to next week. Now, I'm doing this with weekly options, and you can't do this with things that only have monthly options. And so with weekly options, as you see, I can go here. We were looking at selling something about a 40%, 40 delta. And as you see, if you come in here to the 40 delta, if I sold a 30 to 50 delta, that means I would bring in this week actually about $1.50. So then that answers the other question I have is, if my delta is down here and I sell it, does my premium here cover my how much? How much do I need to make every week? 70 cents. So I just answered the question, yes, it does. So that's a positive. And that's how simple it is. Now, if I personally like to sell 40 to 50 deltas, but I trade them directionally. In other words, I wait for the price to run up, and then I try to sell, not at the high, but sell so that I can, when it's doing its pullback. And oftentimes by selling something that is at a 50 or 48, it basically, the value melts off quicker. And my target is, if I can pick up $1 rather than 70 cents, that's great, because that way it puts me ahead of schedule. So this covers the weekly options. And what I wanted to show you also is this is what the rest of it looks like. So downside protection is one, the premiums of 60% delta on the leaps gives you some protection, some cushion. Flat market, if it goes up to 103, theta will have won and you would have paid for your leap option. My target hit is at 4,000. In the example here, I'm using 75 cents per week. Say $875, which covers my premium of a $2,400 investment, plus I made $2,400. My risk management, the risk management being this, I'll put in a good till canceled order that will close short automatically at a nickel. Now, there's a magic about it closing at a nickel. And what do you think that is? It's very simple. If it closes at a nickel, ThinkorSwim doesn't charge you any fee. And then the flip side of that is as I put a stop at a premium collected plus 50 cents. My automatic stop on this is going to be, in this case, if it's 70 cents, so I'm taking a look at, add 30 cents to that, we're up at $1. So I'd probably give it $1.10. I go back to the option table and I estimate a week from now, what price would the option be if it hits $1.10. And then I put that in as a limit order that triggers at that price. Okay. Coming up next, the exact OC order that will protect this trade. Even if TQQQ crashes 90%, that's important to me. Is it important to you? So as we said earlier, if I sell this option here, let's say it's 73 cents. And let's say we get 75 cents for it, right? So 75 times 50% puts me up at 112. So when will that option be worth $1.12? That's what I want to know. I go up here to my Theo price. I want to go out approximately Wednesday of next week, approximately. I'm trying to sell it at 70 cents. And now I want to go out here to the 15th of next week. You see it's 47 cents. It's like it would be falling. What I want to do is I want to estimate, yeah, but what happens if it's at a higher price? And so how high of a price do I need to go to get that up to $1.12? And so I'm just going to start adding numbers here. I'm going to basically go 3. You see it's 25 cents. That means it can go up to 100. What about 5? 86, I'm getting closer. And so I'm going to go 7. And at 7, this jumps up to $1.58. Now that would be on next Wednesday. So that's too high. So now I'll start backing it back down. So at 104.29, or I could just say 104, that goes in as my trigger, and my limit price on the option itself is 112. You need to put in that underlying OCO order of the stop loss. That's the huge thing. Do not use a market order for my stop loss. Watch this carefully. These 4 scenarios prove why this strategy works in any market condition. If this makes sense, drop a TQQQ in the comments. If I'm doing my job correctly, at the end of so if TQQ is down 90% when it closes 65 weeks from now, I still make $4,875. So my net outcome is $2,475. That's a nice little profit, right? If it finishes flat, I still make $2,475. If the price of TQQ closes at $125, well, I'm $15 in the money. So I can collect $1,500 remaining value on the leap, add that to my 4,975 to give you a total of, in this case, it'd be like 6,375. And let's say I closed up $25. Well, I would collect my 475 plus I would add in the 2,500, which would be the intrinsic value of the leap itself. Step 2, risk management and my challenge integration. My risk is leaps can be worthless at expiration. I accept that because I continue to trade and sell premium against it. My edge, I'm utilizing small capital because if I was buying 100 shares of TQQ, would be how much? It's sitting at about $100. 100 shares would be $10,000. You've seen exactly how this works, right? If you want all my best trade setups, my strategies, my tactics laid out step by step, grab my book, Trade Your Way to Freedom. Links in the description. You're ready to take your trading to the next level, aren't you?